Hello, and good evening, ladies and gentlemen. It's a good evening. We are blessed with rains. I believe you have already settled from wherever you are retiring your day to. And we are privileged this evening as Old Mutual to host you for this session. So welcome to our Old Mutual webinar themed NSSF Tier 2 changes effective February 2026. I want to believe this is a very relevant and a very timely discussion for all of us as working Kenyans, as employers, as professionals, as trustees, and the rest. So this webinar will be running for approximately 30 to 45 minutes. We want to keep it crisp, tight, and ensure that we equip you with the tools, the necessary knowledge, the expertise that you require to implement, whether you are attending here as an employer, an employee, a consultant, a trustee. So today, this session will be moderated by myself, Dennis Modito, pension consultant with Old Mutual. And we have a speaker who I'll be introducing in a short while. So before we go to that, expect me to indulge you in a few questions. So prepare to engage me in a few questions. They are not exam-like. I can assure all of you will pass. There is going to be long, correct answers. So expect that as we continue to engage. Just to get us going, for those who are joining, I believe you're able to interact with us through the tab section, the Q&A. If you have questions while the speaker is engaging, you may send questions through the Q&A. The speaker will also guide you in terms of also how you'll be sending your queries or further material that you might be requiring from us. So as a way of introduction, this session is designed for employers, employees, HR leaders, finance teams, trustees, and professionals who want clarity, not noise, on the NSSF Tier 2 changes. For employers, we'll focus on compliance obligations and the decisions required to remain aligned with the law. For employees, because I believe there are also employees who are tuned into this live webinar, we'll explain how these changes affect your payslip. I know that's a big worry for all of us or a concern. I don't want to believe there is really a rational person who is very excited about the deductions. How these deductions affect your monthly take home and what it means for your long-term retirement goals. So as we feel the pain of the monthly deductions, our speaker, I believe today will also be speaking or engaging us in terms of how then do these deductions affect our long-term savings towards our retirement. Our aim today is simple, to cut through the complexity, translate regulation into plain language, and clearly outline what action, if any, is required. This will be a practical session. We'll focus on not so many areas. One, what is changing? What is not changing? What employers need to decide now? And later on, of course, we'll have a Q&A session in which now, please prepare to engage us. Before we move to the main speaker who I'll be introducing in a second, I think all of us will agree with me that over the last few months, we have seen a lot of uncertainty, the mixed interpretations around NSSF Tier 2. And I say this from practice because I receive emails, I receive calls, I receive WhatsApp, everyone having their own, what they hand, either it's what they hand or what they understood. And I believe our speaker today has a simple job, which is to bring in clarity and cut the noise, cut the complexity. So without further ado, ladies and gentlemen, allow me to welcome Ms. Christine Kaloki, who is the Head of Pensions at Old Mutual Life Assurance Kenya Limited. Christine brings In a wealth of experience, exceeding 20 years in practice, setting up retirement benefits, has worked with various organizations, supporting employers and employees alike to prepare for their retirement. Christine today hands the pension or retirement business at Old Mutual, providing critical leadership in terms of supporting employees, employers, trustees, and consultants working in this industry alike. Christine also works with various associations like the Association of Kenya Insurance, where they support various activities that shape the industry, including publication of development and publication of materials relevant to retirement planning. And without, I don't think today I can introduce Christine fully. In the interest of time, allow me to then welcome Christine. Help me welcome Christine. Christine, if you can hear me, can you take over?
Good evening, attendees. Good evening, my colleagues. Send me a thumbs up if you can hear me well. It's raining quite a bit where I am. And also send me a thumbs up if the screen is visible, just so that I can be able to know that you're seeing things. Thank you. Thank you. I see those thumbs up. So today evening, my job is simple. It's to introduce the changes so that we can have a conversation around what has significantly changed and why Old Mutual would be able to say that we are interested in giving you this information. So first, I want to appreciate everyone who on this wet evening has signed up and come into this session. Knowledge is power, so that we can be able to share the information. And I just want to echo the sentiments of Old Mutual and why we are here. The issue of statutory deductions, the issue of retirement, the issue of savings and financial wellness is a key pillar in terms of our ethics and values at Old Mutual. So we believe that we need to become our customers' most trusted lifetime partner. And when you look at the lifetime of NSSF, between 25 to 40 years of contribution, for sure, that is where we align as your lifetime partner. So as a leading African anchored financial services group, it's very important for us to be here this evening. So in brief, what I will be sharing is I will share the contributions and regulations overview so that we paint the picture, and then we talk about what has changed. And then we tell you the reason why we are here is because there is value in understanding what can you gain, how do you understand the aspects of NSSF in terms of growing your savings, and then I'll hand over back to Dennis for the question and answer. So in brief, your partner and your lifetime partner in financial services is a brand that spreads across the whole of Africa, and it's an African brand. But we want to focus on East Africa and say that we're a multifaceted institution, and we call ourselves a financial services provider, because what we do is we offer general insurance, we offer health insurance, we offer life insurance, we offer asset management, and we offer banking solutions through Faulu. So you find that we are multifaceted and look at the whole aspect of a client and are able to speak to you from your point of your pain points and provide solutions that are able to help you in this aspect. When we drill down to matters money, and this is where we are in terms of managing your funds for you, the one thing we know is that integrity is a key aspect. And integrity comes out when we are able to give you true reports, when we are able to give you the right information. You should be able to have trust and accountability by being able to say that when you ask for a report, it is provided for you in good time. We are able to give you feedback in a timely manner, and we are able to keep our commitments in terms of payment of benefits when you need them. We do respect you as our client and the communities we serve, because we then provide solutions that are diverse. We not only factor for big institutions, mid institutions, but also the micro and SME institutions. So we have solutions across the board, showing that then we understand the communities we live in and are able to serve them. We're able to champion you, our customer, because then through engagements like this, we're able to pass on information, but above all, When you look at the investment aspect, we're able to give you performance that allows that you're able to settle well in your later years with comfort and no disturbance in terms of being able to be well taken care of. Our platforms and our ability to provide you solutions on the internet and be able to speak to you through our socials and the media shows that we are agile people and we adapt to innovation. And this makes a difference in the way we serve you and the way we give you quality service. So for us, we do believe that as a company, the power of diversity and inclusion is seen in the vast expanse of our clients and the people we serve, but also in the communities that we support through our profit share. So that being said about Old Mutual, allow me to set the landscape for us. So the reason why we have this conversation this evening is because we expect to be able to have a lifetime. So when you consider a person who has stopped actively working, today we say retirement is not an age, it's a lifestyle. But as you consider this, then we want to say that we do not want you to face age-old poverty. And age-old poverty is where you do not have enough to cater for your living expenses and the sustenance of daily living. We do know that we cannot go back to our children, our communities. So you have to create a structure and a system for yourself that works and is able to replace your salary or your earning capacity when you're older. In a survey for 2024 by the Retirement Benefits Authority, it showed that the increase in dependent children is by 34% up to the age of 30 years. So you find that we have dependents for longer due to social constructs and changes in the way society operates. Again, the same survey by the Retirement Benefits Authority indicates that in above 50 years, 55 years, 40% of your expenses will go to medical issues. So then we need to also be able to adapt for this and prepare for this. And then, of course, if we do not make the right choices today, and that's why we're in this session today having a conversation, then of course you will have a crisis of inadequacy. So how then do we provide adequacy for you as Old Mutual? And this is what we are going to showcase for you shortly. So all these are aspects of financial planning. And this is one of the key pillars of the institution, being able to help you look at various aspects of financial planning, retirement planning being one of them. So the National Social Security Fund was set up in 1965. So when you look at these funds, it was under Cap 258 of the laws of Kenya. So the establishment of this fund was to allow people to accumulate a fund, and when they get to the age of retirement, they would take a cash lump sum, ile watu huita malipo jumla. And as per the last part of the act, the contribution was 200 by the member and 200 by the employer coming out of his expense account. So there was a change, and this change came to affect us in 2023. However, the story of this act has been there since the year 2013. So the bill was passed on December 4th, 2013, and signed into law on the same month, on the 24th of December. It was set for commencement on 10th of January 2014, which was a few days after that. However, due to various court cases, placement by the labor unions in the employment, there were deferrals, there were decisions. However, we do know that on 8th of March or 8th of February 2023, this act came into force. So what happened in it? They converted the Social Security Fund from a provident fund into a pension scheme. And the benefits arising out of this one were, the first is a retirement pension, meaning that you save, and when you get to the age of 60 years, then you take the lump sum and you convert it into monthly incomes for the rest of your life. If you're not an East African citizen, you're allowed to immigrate with your benefit, meaning that a cash lump sum is sent back with you of the fund accumulated. If at any point you're unable to continue working and retire on ill health basis, then this is called an invalidity pension. So your accumulated fund is converted into a pension. In the event of untimely demise, then your benefits are paid to your nominated beneficiaries. And if you've been a member for more than 36 months, then you receive a funeral grant of 10,000 shillings that goes towards your funeral expenses. So why the change from the old act to what we call the new act, which is the Act of 2013? So when you look at the contributions of the old act, there was a question of adequacy. And adequacy means how much have you accumulated and how much of it will be able to replace your last salary. So of course, when you look at a value of 1 million versus a value of 5 million, then adequacy then is created in the new act because it has higher contribution rates. Again, they increase the membership coverage so that then a wider pool of people, reducing the social burden on old age that the society has. So if more people have enough funds, then as we retire, then we do not depend on society or social structures to provide for us. So it also brought into the scope of the Act employed persons to access social security for themselves and their person. So in this, then they meant to operate and manage the scheme in its value. So it's ensuring that it's sustainable, affordable, and providing for members by increasing our contribution rates. So when we talk about contribution rates, what has changed significantly? So we moved from 200 plus 200, which was 400 per month, to 12% of pensionable salary. When I mean the word pensionable salary, it means any income you earn that is basic plus standard allowances that do not fluctuate on a monthly basis. So then that means it's a gross salary. So this contribution is considered as 6% from the employee, and the employer will match this contribution from his own funds at the rate of 6%. When we make our contribution, this contribution is submitted in two portions to make the total of 6%. The first portion is what we call a tier 1, and the second portion are what we call a tier 2. How we arrive at tier 1 and tier 2 is based on a schedule that has been published. And so we will be seeing how this schedule looks like for the year 2025, 2026, and 2027, so that we have comparison to align with our discussion of what is changing. What we would like to let you know is that the minute the money goes to NSSF, it is yours. You're entitled to it. You may not access it immediately, but you are entitled to it and nobody can deny you. So these benefits cannot be attached to loans. They cannot be attached to other services. They are basically meant to be accessed when you stop active working. So you have contributed. We will be talking about investment. The fund has grown, so you've come for it. How are you eligible to access this money? You're eligible to access this money at the point where you are of pensionable age. And the Act defines this as 60 years. Or in the case of Kenya, we recognize an early retirement from 50 years. And you as a member are directed by the Act to purchase what we call an annuity or an income drawdown. In basic terms, it means this fund that you have, let me give an example of 10 million. You're supposed to convert it so that every month for the rest of your life, you receive a monthly income for you. So let's look at the math. The math looks like this. You are deducting 6% of your salary up to a certain limit that is set by the Act for the year you are in. So if I take an example of 2025, the upper limit, or should I say the maximum salary chargeable to NSSF was 72,000. In the year 2026, the maximum salary chargeable is 108,000. Come next year, the maximum chargeable, sorry, that number is wrong, is 144,000. So what has happened is they will tell you the tier 1's contribution is from 0 to what we call the lower earning limit. So if we look at the year 2026, the lower earning limit is 9,000. So they will charge 6% of 9,000 to get 540. And then they will take the difference of 108 and 9,000, which gives us 99,000, and charge 6% of it to give you 5,940. So when you combine the two, it comes to 6,480. So this 6,480 is the member's contribution. Now, as a member, your employer will also contribute this. We do recognize that if someone is earning a lower figure, it will be up to the maximum of their salary. So for example, someone is earning 70,000. It will be up to 6% up to the maximum of 70,000, split tier 1 for 540 and tier 2 the difference of that amount. So having arrived at how we come to these contributions, then the major thing we need to recognize is the significance in the values of these contributions. If you look at the tier 2 contribution, it is 3,840. If you look at the 26 tier 2, it significantly moves to 5,940. Now, the differentiation in contribution between 2025 and 2026 is 2,160. And if you ask me, that's significant money for me. I don't know about you, but for me, that's significant in terms of movement. That's over around 30% in terms of change. And that's huge. When you look at the shift to 2027, and you look at what you are contributing in 2025, the difference in the double years, that's why I've written there ×2, is 3,720. And that's speaking to another 30% increment overall. But from the previous year, it aggregates at around 40%. So the reason why we are having this conversation is to sensitize members, one, to understand the change in their payslip, that this change in their payslip came about because the limits being charged for NSSF were increased from 72,000 shillings to 108,000 shillings. And next year, they will move up to 144,000 Kenya shillings. The second thing is to highlight that there's an aspect called Tier 2, which is a significant portion of this fund that your employer has control over in terms of investment and gains that a member can have. And that's the second part of this conversation we want to go into. But before I get to that part, this illustration allows us to see the deduction per member in the year 2026 based on various salaries. So we know there's a diverse range of earnings in Kenya. So when you look at someone who's earning 15,000, their total monthly contribution to NSSF is 900 shillings, of which 540 is tier 1, 360 is tier 2. When you look at someone earning 70,000 Kenya shillings, their contribution to NSSF is 4,200. Now, your tier 1 remains 540. However, the difference is 3,660, which is your tier 2. When you look at someone earning 120,000, their total contribution remains 6,480 because the maximum salary chargeable for this year is 108. So their tier 1 remains 540 like everybody else. Their tier 2 being the difference is 5,940. So these values then makes people, you could go, someone tells you, oh, but my payslip shows. So this table is able to illustrate for you that it is because of your salary that there's a graduation. But the maximum salary chargeable in the year 2026 is 108,000 Kenya shillings, which is 6,480 being the maximum. So we all know that tier 1, because it's based on a salary of 9,000, is 540. So the difference will always be your tier 2 contribution. And in my opinion, it's a significant amount. So the second part of this conversation that we are having today is so that then we can have awareness. What does it mean that of these significant amounts? So at All Meju, we believe that people should have full information, full clarity, so that you are able to grow your money in the way it works. So allow me to go back a little bit. If you look at the amount of 5,940 in terms of contributions, okay? If I multiplied it by 2, meaning the employee and employer contribution, that's 11,880. If I did that over 12 years, that value is 100, over 12 months to make a year's contribution, that value is 142,560. On average, as an individual, you're in NSSF for 30 years. So when you multiply the annual contribution by 30 years, that gives you a figure of 4.3 million as a contribution. So that's the reason why we are saying it is significant for us to have a conversation. And what does this conversation say? It says that in the regulations, all Tier 1 contributions mandatory must be submitted to the National Social Security Fund. But it also allows you in the same regulations that the employer, through approval by the Retirement Benefits Authority, may opt to pay their Tier 2 contributions into a scheme. And this scheme is called a contracted out scheme. And so this is a private scheme, and Old Mutual offers such, that allows the employer to participate in this scheme and submit their Tier 2. So there are various reasons why you would do this and look into the factor. But the most important is basically you're looking at the issue of investments of a fund. You've chosen somebody to invest this money for you, and you're assessing those investments on an ongoing basis and making a determination that you're in a better place. So the fund that you can be able to put your Tier 2 can either be a standalone employer fund, an umbrella fund that accommodates diverse employers under it, or an individual retirement fund. The key factor is that this fund should have a license from the Retirement Benefits Authority to receive the NSSF Tier 2 contributions, and we are happy to confirm that our fund at Old Mutual is able to receive. So in a very simple way, let me break down for you in 2 steps how you contract out. And contract out is the process where the employer makes a determination and says that I will invest my Tier 2 in a private fund at Old Mutual. So the first step is you become a member of a fund. And for us, we recommend the umbrella scheme. And why are we recommending the umbrella scheme? We're recommending this scheme because it has various advantages that I'm going to highlight in the next slide. Then the second step is you contract out of NSSF. And when you contract out, you make an application to the Retirement Benefits Authority. And what you receive is a certificate as an employer. So it means that then the employees under you, through your application, are able to invest into a private retirement fund at Old Mutual and grow their funds while being able to interact with their funds through the online platform, being able to manage their funds, but also allowing them portability as they work for diverse employers, and also allowing them to accumulate. You could work for employer A and determine that you're going to compile all your previous employers' NSSF funds into Old Mutual and be able to hold them there as you work throughout your working lifetime. This is a possibility. So an umbrella scheme by nature is what it means. It's a scheme that covers diverse employers under one scheme. Sorry?
Excuse me, Christine. Yeah,
Yes.
Sorry to interject you. Just a quick check. So as a listener, we are wondering whose responsibility is it to contract out? We are many here, we are trustees, we are employees, we are financial consultants, we are employers. So in terms of action, if I'm interested today, how do I go about it? Whose responsibility is this?
Okay.
If you answer that, I can assure you, your listeners will also answer one question for you.
Okay, that is a very good question, Dennis. Can I answer it immediately after this?
Yes. So at this point, before you proceed, I think I'll ask our listeners to just answer one simple question. And I'll ask my technical directors to post a question for me. So listeners, we have a poll coming up. And the question is, I hope my technical director is with me. As your employer opted out of NSSF Tier 2 and enrolled into a private retirement scheme. I think the poll is very simple. It's a multiple choice question. I expect 120% score from everyone. So in 30 seconds, let's go. I believe everyone can see the poll is in front of your screen. So if you are listening, you can now turn on to your screen. Yeah, we can see your questions. We'll answer them during the Q&A, but for now, kindly answer the moderator's question. I believe we have had enough time to read that and answer it. As your employer opted out of NSSF Tier 2 and enrolled in a private retirement scheme, this question assesses your understanding of what the speaker has taken us through. So if we do not score very well, I'll ask the speaker to take us through a remedial session. So please ensure you score well if we want to end this session early today. Thank you very much. I believe we have had a chance to respond to that, and I will return the conversation or the engagement to the speaker. Christine, kindly proceed.
Thank you, Dennis, and thank you for that timely inquiry. It also allows me to take a breather. I tell you, members will be done in a short while, and then we can engage on your questions. So I had indicated that under the NSSF Act of 2013, an employer is allowed to be able to make a decision to take the Tier 2 portion and invest it out of NSSF. And this process is called contracting out. When you contract out, there are two requirements. One, you have to be a member of a retirement scheme. And two, you make an application to the Retirement Benefits Authority. So as Old Mutual, we're telling you that the umbrella scheme fits the need and service for this one. The scheme is already registered. And so it's as easy as filling an application and you already have a retirement scheme ready for you. We take over the investment performance and it has been excellent. My colleague Eric will be able to tell you that we declared 14% and we expect that trend to keep going for the future. So this is a good return for your NSSF Tier 2 portion. We take on the responsibility of governance and compliance, and being a company that's been in the market for 180 years, this is something we are committed to and are able to do and are able to manage it on your behalf. When you come in as an employer, you join a pool of other employers, so you're able to enjoy economies of scale in investment and access to quality and high-class asset classes that then boost your return and also boost your fund for you. Of course, being many employers under one umbrella, you share the expenses of managing the scheme. And so the reduction in terms of expenses is quite significant as when you would have stood on your own. And of course, I did say that setup is one step. So after you become a member of the fund, the second part is what Dennis was asking. What then happens? So the employer will make an application. I will not go through the full documentation list, but this will be available for members later through your registration contacts. And the Retirement Benefits Authority has provided a transcript. So what we've done is we've compressed it into a simplistic application format. And what we've done is we've also done templates for you. And so it's a one-stop shop for you. You join the umbrella, and then we support you to make the application by providing the necessary documentation for you to execute. And then it's as easy as that. So Old Mutual will file for you your application, and you will get your approval through a certificate by the regulator. And then you start to remit your NSSF Tier 2 to Old Mutual. We work with you every step of the way. And we make sure, because we are the powerhouse of knowledge, technical existence, that we work with you through every step of the way, because these are the values we live through. So in summary, what we do is we facilitate your application and ensure that you are fully contracted out within the shortest time possible. We facilitate and ensure that your records, both as an employer and for the members sitting under the employer, are up to date and balanced, and that they are accessible through online platforms for the member to interrogate and to review. We provide annual statements to the member, both physical or online. We email them to you, but you can check them through your portal and access it yourself. Through the same primary portal, we are able to manage your information and manage necessary updates for you. We process and pay benefits and can assure you our timeline for benefits is within 2 weeks, so that then members who are retiring out of the fund are able to access their money in a timely manner and start receiving their monthly salaries. We do offer advisory services because we do understand this journey is long, and along the way, life circumstances change. And remember, we said that we're your partner throughout your lifetime. So we work with you through your journeys in terms of when you're starting, when you go on, when you're making decisions, and at the end, when you're making the options of what benefit to take and how to take it and where to take it. And of course, we invest and manage this fund to ensure that your 4.3 million is 20 million by the time you're going home in terms of stellar investment returns credited to the fund. One of our key pillars also is financial literacy. It's not enough to build a fund. It is also important to have the knowledge to know how to manage this money, but not only for retirement purposes, but other aspects of your life outside of this retirement aspect. So with that, Dennis, that was what has changed for us. Happy to hand it over to you for the next session of the presentation. Thank you.
Yeah, thank you, Christine. I think to me that was excellent, but our listeners, I hope the same goes for you. So for any questions and clarification, I think from the screen, our listeners, you can see there is a tagline there, SMS pensions to 2208. That helps us respond to maybe things like you want us to talk to you more about NSSF Tier 2. And before you do even proceed to that, I would like you to help me with one more poll, which again we are going to answer. I think we are going to answer like two sequenced. The next question, I hope our listeners, you are ready. Before we go to answer your questions, I want to ensure you do not have any of my debts. You'll answer all my questions before we can start answering yours. So my question, and I believe, again, my director is with me, is that which best of the below describes your role? Yeah, I think that's already up on the screen. Which best describes your role? You could probably be more than one thing to, when you are listening here, you could be an employee, could be financial consultant, an advisor, you could be an HR. You can respond to as many items that describe you. We have 30 seconds to respond to that. I think by now we have understood the moderator's exam structure. Like I said, I'm very lenient when I'm marking. We will be returning the results slip tomorrow, and I can guarantee you if you're going to pass because you're good listeners. So I think with that, you've already responded. So I'll answer a few of your questions before I can learn the next poll because you owe me one more question. So at this point, thank you so much, Christine, for walking us through that very, I think, like I said, for me, that breaks down the complexity, cuts the complexity, and sets things more digestible for our listeners. And additionally, I think also you have done well on time. Thank you for that. Kudos. So on to the Q&A, and I believe we have a couple of them. Let me just check. I believe the people supporting me are also on standby in terms of those who are going to help me respond to this. Eric, you are mentioned at one point. Moses, you also mentioned. So the first question I'm seeing here is, what's the administrative cost in percentage that Old Mutual charge? So as I gather the rest of the questions, Eric, if you can hear us, please open your microphone and help us respond to that. That's from Jasmine Waithaka. What's the administrative cost in percentage that Old Mutual charge?
Thank you, Dennis. I do hope I'm audible.
Yes, Eric. Yes, Eric, proceed. You're audible.
Yes, so I would like to respond to Jasmine by indicating that the fund has a 0% charge on the member fund values. So you can be assured that you incur zero cost on the administrative services for your NSSF fund.
Yeah, Eric, before I am bombarded with more questions, so how do you manage this? You don't charge me anything. Do you want to help us understand that? I know that's a little press on you, but you would like to understand as listeners, as employers, as employees.
All right. Thanks for pressing harder. So, given that we are in the investment field, so our main aim or objective is basically to ensure your fund grows. So, Christine alluded to you giving us 4 million, and the intention being to grow it to 20 million. So we ensure that we employ the most prudent investment strategies that maximize returns in the market, such that we are able to, number one, ensure that the capital, the original contribution that you've given us, which is the 4 million, is protected from any form of erosion due to market performance. And additionally, we get the highest possible returns in the prevailing conditions. So with that, we are able to, number one, take care of the investment costs, or rather costs related to putting your money in the market, and at the same time grow your fund, and that is give you the high return that we are able to give you. So for the 14%, it means we've been able to maximize returns for that particular year, taken care of all the investment charges that are related to that, and given you the highest return in the market.
Thank you, Eric. Excellent. Thank you. Thank you. So, then as we move on to the rest of the questions, some of them are comments. Phyllis says some of us are not employed. I don't know that it's Christine or Moses who want to comment on those who are not employed. What solutions do you have for people who are not employed and still want to retire like you, Moses, someday? I know the journey is long for your retirement, but what would you like to advise Phyllis in 10 seconds? As you do that, also answer what about those currently out of work? Well, I believe it's the same case with Phyllis. Yeah. Moses?
Thank you, Dennis. So for those of us who are in the informal sector, or we have our own jobs, you are able to have an Old Mutual individual personal pension plan, which is a very flexible plan. So it enables you to save for your retirement. I think when Christine was started, she did allude to some of the key facts about retirement and the need for us to start planning. So Old Mutual, we have a solution that would enable you to be able to save. So it's flexible. That means you are even able to save through your mobile phone. You can be paying via our pay bill number, and you'll be able to get updates all the time through the online platform. So you don't even need to be coming to our offices here at Upper Hill. Through the portal, you're able to even project, see what you have saved. Is it sufficient, or do you need to do more on the same? And also, Phyllis, you had also had a follow-up in terms of NSSF. You mentioned you do have a PVP with us, and thank you for the support. So for in terms of NSSF Tier 2, if you are in an informal sector where maybe you are not getting a salary that is going through a payroll, now the personal pension plan would come in handy. But if you have a company and you have employed more than 2 individuals, I would encourage you that you take advantage of our old mutual umbrella scheme to contract out so that you are in line with what the Act states. Back to you, Dennis.
Excellent. Excellent, Moses. Yeah, thank you. Thank you, Moses. I think you did exactly what Old Mutual does, going beyond the boundaries and doing excellent for our customers. So at this point, I'm running through the Q&A to see what other questions we have. One here, I urge your patience as I read Devin's question, or there is a comment. I probably, some of you will relate with Devin's situation, and I believe he can get advice from this conversation. I work for an NGO in the United Kingdom. The NGO has engaged an employer of record company to manage our payroll. This company is called Pioneer. Pioneer employs staff on behalf of employers globally and manages their payroll. Currently, Pioneer has several companies in Kenya that they are managing their payrolls, and they use NSSF for both tiers. Pioneer approached NSSF to contract out of Tier 2 for one of their clients in Kenya, but NSSF informed them that they needed to contract out of NSSF for all their Kenyan clients. Question: can an employer opt out of NSSF for some staff, but not all? I think I want to take this to the speaker. So, Christine, if you don't mind, allow me to indulge you one more time to support David.
Thank you. David, your question was quite complex. And I've seen in the chat, we've responded and said we can take this because the query is very specific and has many intricacies. But from what I understand, Pioneer is an aggregator of various service providers and employers. And so the one thing I would say is NSSF cannot, the application for contracting out does not go to NSSF. It goes to the Retirement Benefits Authority. So the employer, if we define an employer who has staff under them, would be the one making the application to the Retirement Benefits Authority. And so we support with that application. But before the application, you have to evidence to the Retirement Benefits Authority that you belong to a retirement scheme. And so we recommended the Old Mutual umbrella scheme to be able to be the first qualifier, second qualifier. We support you with the application. Now, the intricacy of Pioneer is we're not very sure about the contracting terms under Pioneer. Are they diverse employers who then each of those successive employers, or is it Pioneer themselves who should then go? But having considered that they have diverse employers under them and are providing a facilitating service for payroll management, then it would mean that your specific employer would make an application and be granted the right. And because you're working and you're a resident of Kenya and being done the deductions, this is okay. We will be able to support you in that. But for me, that would be the highlight. Application is done to the Retirement Benefits Authority, not NSSF. And before you make your application, your employer who employs you should be able to be in the Old Mutual umbrella scheme. So for that, we will reach out to you through your contacts, or I've left our email address for you in the chat. Then we drill down into the specifics, whether it's Pioneer or your employer in the UK who makes that application to support the employees. The second part of the question was whether it can be a partial contracting out or full contracting out. You define the level of staff that you want to contract out. So you find that some organizations have permanent and pensionable, they have contract staff, and they have casual staff. So they determine whether they're contracting out for all. It's a decision that the employer makes, or they are contracting out for some. We have not come across any employer that has defined for some of the staff because of the values of contracting out that should allude to all employees regardless of the contracts they have with the employer. But yes, it's possible for an employer to determine what category of staff to contract out for, and it's provided for in the Act. Back to you, moderator.
Yeah, thank you, Christine. I think what in short you have done to David, you have given him hope that yes, it's still possible, but there's still some level of engagement or process that is involved in the complex scenario he has found himself in. So I encourage David to reach out to consultants at Old Mutual. For anyone wanting more information beyond this, including the write-ups, including the presentation, guidance on the process, you can write to us through our pension services at oldmutual.co.ke, pension services at oldmutual.co.ke. For general inquiries, you can send pension to 22, allow me to clarify, 22801. And I believe we'll get the correct email and correct USSD on our chat. Please reference our chat. Someone is going to post both our email and our short code where you can reach us to get more information. Susan Karani asked, what happens in the unfortunate situation a person dies? Eric, you know the moderator is buying dinner today and there's a criteria for qualification. So welcome to support Susan in answering this. Eric?
Thank you, Dennis. I hope I qualify for dinner after responding to this question. So
Depends.
Susan, yeah, so in the unfortunate event of loss of life of a member of who has been contributing towards the retirement fund through the NSSF in compliance with the NSSF Act. Christine took us through some of the benefits. So one of the most immediate benefits your dependents would be entitled to is receipt of the funeral grant, which for which the condition is having been a member for 36 months. That's about 3 years. So that becomes an immediate benefit. Additionally, your accumulated fund value, which I can call credits into your account, would also be payable to your nominated dependents. So it's very key that you pay specific attention to the persons you nominate to be your dependents or beneficiaries. So that then there would be no struggle for them to get these benefits. And for those who are then within the Old Mutual space, you would know that you can actually do this through the online portal. So you can just log in, update your beneficiaries listing, put in where we have a minor, ensure you have a guardian nominated, so that in the unfortunate event that happens, we are able to discharge these benefits to them without hassle. And that's normally within 10 business days at All Mutual. So back to you, moderator. I hope I've done justice to that question and I've earned my dinner.
Yeah. You just are not yet to get your salad, Eric, and you need it. I want to understand when Christine was presenting, she mentioned that the accrued accumulated fund towards the member would be paid out either as a pension, which she said as either gratuity, not gratuity, rather annuity, or income drawdown, which are all forms of regular payouts, like monthly payouts towards an employee's retirement. Now, in the case of demise, Eric, what happens? Will my children, my spouse, or whoever will be my beneficiaries be paid in the same manner, or what do we expect?
So your nominated beneficiaries would receive a lump sum of your accumulated fund credit. And this would be tax-free. I think there were changes recently which then allowed that these benefits be treated as such. So we would then discharge the benefits as a lump sum to your nominated beneficiaries.
Thank you, Eric. You're almost there. You know, you need a soft drink because I don't serve those others. I'm sure we can talk about that later. But in the meantime, I want to take back to the speaker briefly. Christine, could you walk us in a minute about the tax expectations at both the contribution level when you are being deducted and at the payout? What can you tell us about the tax status of these benefits, whether they are contributions or the payouts, in 1 minute? Thank you.
Thank you, Dennis. Contributions, as the current NSSF Act provision does, is it provides that all contributions are deducted from the payroll or payslip or from the employee with notes applicable on them. The fund is expected to accumulate, and as per current Income Tax Act, when you're receiving your benefits, no tax is applied on the benefit when it is being paid to you. That is the current position in terms of taxation.
Wow, thank you, Christine. I think that's something on the positive, that I can avoid taxes when I'm employed and when I'm retiring. Again, I won't pay anyone. Yeah, those are some good news. And thank you for clarifying that. So, listeners, you still may have a question, but I will still ensure that the panel here answers more of your questions than we are asking you. So those who are asking whether we will share the presentation, yes. Those who are asking whether we will share the recording, me to be guided, but I believe the answer should be yes. Yeah. Everything being discussed here is for your consumption, and you can use it to reference. So make sure you leave your email through pension services at onmichio.co.ke or through the short code if that's possible. I believe the most efficient will be to send us your email. And of course, it would be nice if you could know where you're coming from in terms of your employer. When you're sending that email, that's not a condition. We'll send you the presentation, the recording nonetheless. The next question that I would like to our channel to read, to provide responses to, what options do you have for people in diaspora? Again, because our speaker volunteered today, and I think I ran a very heavy CV of our speaker today. Again, I give that to you. Christine?
Thank you, Dennis, for such encouraging words. For the diaspora, we are able to receive your retirement savings through our personal pension plan. And so we will accommodate you into the individual retirement plan where you then make your savings. And the beauty of the individual retirement plan is that it's flexible. It accommodates individuals because it's not employer related or employer structured. And so the flexibility of contributions, there's flexibility of being able to set timelines and goals set for yourself. So yes, Dennis, we're able to accommodate diaspora people. We are a company that has many solutions through our individual retirement plan.
Thank you, Christine. Excellent. And looks like you are shining today, Christine. Someone is asking, can you please share brochures of the package and kindly share Christine's email in case of any query on one may have? Yeah, so listeners, Susan has asked, but to ensure we share Christine's contacts with everyone, I'm sure she has been quite resourceful and she can continue to support you and your organizations and employees alike. So that is assured, Susan. Rest assured that we will share Christine's details as well as the write-ups that you can reference regarding these conversations of today. You can also reference some of the responses through the Q&A, the engagement tab, the chat, be able to see some of the answers, anyone who has a question. Let me see if it is, if the interest rate for umbrella pension is same as the individual, oh, sorry, I think I learned that wrong, pardon me. Is the interest rate for umbrella pension same as the individual pension contributions? Moses Jugona?
Thank you, Dennis. Thank you, Dennis, for that question. So in terms of contribution, the contribution is 6% of your pensionable salary. So, and also in terms of the rate that we declare, so we do not discriminate. So when you're doing your personal contribution, we give you the same rate as when you give your NSF contribution. So we ensure that we invest in very high and well-diversified portfolio to ensure that we give you a return that are above or very competitive and above the market. So yes, we do not discriminate between the NSF and even your own contribution.
Yeah, thank you. Thank you, Moses. That was bravo. Let me see. Jacqueline, good evening. Good evening, Jacqueline. If the online portal does not work and one can't access the statement online, what should one do? Eric, I think I understand we are not done with you yet, and clearly we are not. Eric?
Yeah, thanks, Dennis. I did respond to the question. So in the event you do experience any challenge logging in, maybe first time logging in, maybe you're having trouble resetting your password because we've noticed such kind of the errors or challenges we see within existing members. So we would encourage you to just write an email with the screenshot of the error to pensionservices@mutual.co.ke. The email is on the chat. We will pick it out, call you, and just assist you login or assist you with the challenge you're facing. Back to you,
yeah. Thank you, Eric. You're doing well so far. Clap for yourself. I wish the listeners were in this room so that I can request a few pat on the back for you. This one I want to ask Moses, and Moses, I want quick answers, 10 seconds answers. What was your last year's interest rate? I'm asking this for the sake of all the reason I know you answered, but for the sake of the rest.
Thank you, Dennis. So in 2024, we declared a net return of 14%.
Excellent. Thank you, Moses. Could you share the link to the Android app if available? Definitely, yes. If you are able to share, I'm not sure which link is that, whether it's for joining this meeting, is it for joining this? I'm not sure which link is that. If it's the links for the portal, yes, those will be shared. And I believe Eric, there are some who are already our customers. Please, you can share the online portal. I think some answers from Susan. Can you please clarify how to calculate NSF tier 2? Susan, I think you have been answered. There was a response there. And anyone wanting to reference that, please leave us with your email because we'll give you write-ups, including brochures that are very clear in terms of illustrating the calculations. And if you're already our customers, please reach out to us so that we can send you raw templates of calculating NSF tier 2 instead of struggling with separating tier 1 and tier 2. I know that some of the struggles maybe some of our customers might be having. Or even if you are not our customer, we can still support you. Reach out to us. We can give you templates to help you calculate both tier 1 and tier 2. Will you be sharing the recording? Of course, Francis Suma, going to see you here. Yes, the answer is yes. We'll be sharing, but please leave us with relevant contacts to be able to channel that to you. Of course, I gave the email and it's will be given on the chat. Pension services at oldmission.co.ke. Looking at whether we have any other questions that have not been answered. Of course, Moses saying pensions to 2208. I hope you have tried to do that. I see Alpha Huma as a comment there. Must your pension be converted to annuity or income drawdown upon retirement? Is there a provision for all lump sum of the entire amount? Allow me to recall the speaker because he took on that to answer that. Christine?
Thank you, sir. The new law in the previous act where we used to contribute 200, you could take the lump sum. And I think that is what usually happens. But in the new act where we are contributing 6%, you're not allowed to take a lump sum. So 1/3 is the maximum you can take out in cash. The rest, you have to patch what we call an annuity or an income drawdown. And in simple terms, it means that you convert the lump sum into a regular interval salary that is paid to you on a monthly basis for the rest of your life. Back to you, moderator.
Before you go, Christine, even without dropping your microphone, I have a question here. Is there room for me to do extra contributions if I want to boost my retirement package? And if I do so, will my extra contributions be treated the same way as NSSF contributions during payout? Christine?
Congratulations to the person who asked that question. That's a very forward-looking aspect in terms of growing your financial wellness. So the extra contribution is known as additional voluntary contribution. And by nature, because it is voluntary, it will not be treated the same way the statutory NSSF deduction is. We have the capacity to be able to separate what is NSSF tier 2 and your voluntary contribution. At the point where you come for your benefits, your voluntary contribution is available to you in cash lump sum. Back to you, moderator.
Thank you, Christine. That was excellent and also a good question from the person who asked the question. Looking at this, I think we will try and maximize the remaining few minutes before we can send. Can an individual contribute? Maybe Moses can help us.
Thank you, Dennis. Yes, so an individual can contribute, so in two ways. So if already you have contracted out through your employer, you can make the NSF contribution, and over and above that, you can do what we call additional voluntary contribution. So that would enable you maximize on your tax incentives at payroll. The other way you can contribute is through opening a personal pension plan, where you're able to make flexible contribution through the different modes that we're also able to advise. Back to you.
Well, Well done, Moses. That was excellent. Yes, Ellen Ngeno, I believe you are well answered. Yes, an individual can contribute, only that the modalities are different for NSSF tier 2 or tier 1, and the voluntary contributions that you can make, as Moses has provided answer to us. Eric, looking for you again. What kind of assets do you invest in? Eric, if you can hear me.
Yes, I can hear you, Dennis. I believe this now answers this. This will earn me my dinner for sure. So, first of all,
I hope
as a
so.
prudent, as a prudent manager of customer assets, we abide by the existing regulation for the pension industry. So the Retirement Benefits Authority provides guidelines on which asset classes we can invest in. It ranges all the way from government bonds and papers, equities, alternative investments, and what have you. So there are limits ascribed to that, but as all mutual and as a company that is interested in, number one, preserving your capital, growing your fund at a rate not only beating but exceeding inflation, to ensure that at the point you retire, you have a big wallet that will allow you to take care of yourself at that time of retirement. We ensure we have a balanced portfolio within the guardrails we have provided by RBA. So there's what we call Table G of the Retirement Benefits Investment Guidelines, which we follow through to safeguard and maximize returns for your fund. I think we might need more time for me to break down exactly what portion of the fund is where now, but just as a highlight, that is how we have put your funds within the investment market.
Thank you, Eric. I believe you have done justice to the question. One more question for Moses. And before I go that, I think Alpha or Uma, so can I withdraw AVC anytime? I think if I hand the speaker Alpha, well, it depends on where you are sitting, whether it's a personal pension or the umbrella. But once you retire, what I earn from the speaker, it won't be subjected to the same regulatory constraints as your NSF Tier 2. It is payable to you in full lump sum if you so wish, but you'll have the options to convert it, whether you want to convert it to an annuity or income drawdown. It will be your own option, but it will be available to you, unlike the NSSF Tier 2, which must be converted into a regular income through the solutions that were mentioned by the speaker. To Moses, there was a question here, Moses, I think is disappearing, and you need to earn your dinner as well. Aaron Ngeno is saying, thanks for the answer. Can it be done as checkoff?
So thank you, Dennis. Thank you, Helen. So yes, for the AVC, you are able to do it via checkoff. And as I had even our speaker mentioned, and this has been also mentioned, it would enable you to reduce your tax liability. So we even encourage that, be it for the AVC, for that is in over and above the NSSF, and also for your personal contribution where you have joined it as individual. You're able to do that through AVC. And maybe so that I earn my dinner, moderator, allow me also, she has another follow-up question. And a follow-up question to check off, am I allowed to withdraw it or it all part of it before retirement? So as the moderator has mentioned, it will depend on where you lie. So if it's under a personal pension or an individual pension, you will be allowed to withdraw. But if it's tied to an employer, in regards to the RBA Act and the NSSF, you'd have to have first left employment. But the good thing, also just to reiterate, is that the NAVC that you contribute, you are able to get the entire bit. This one will not be forced to buy an annuity or an income drawdown. Back to you, moderator.
Thank you, Moses, and excellent. Thank you to our speakers. At this moment, I want to open the microphone, but before I do that, you listeners, you owe me one more poll, and I want to ask my technical director to run that. In a moment, you'll be having something on your screen. Kindly take 20-30 seconds to respond. Waiting for that to come up, and we have it. What best describes your interests after today's session? I believe, like we said, it's a multiple choice. I used to score the highest possible when I used to do this back in the day. And back in the day is really back in the day for those who cannot see my face well. But I used to score well. What best describes your interest after today's session? I'm counting from 15 downwards. When you get to 0, the poll will be closed, and we'll move to the open microphone for those who have very burning questions, because we have very, 7 minutes before we can close this. Yeah, thank you very much. If you have a burning question, please raise your hand, and you are now free to open your microphone, but you're not speaking. Kindly let your microphone remain muted. Any other question coming after this on the chat, we'll look at it and answer directly from the chat. But now it's time for open microphone. You can actually open the microphone and speak, but please raise your hand so that we are more orderly. Thank you. Yeah, looks like we are all satisfied. Once again, we are very grateful to you, our listeners, those who tuned in today to our live webinar. And I hope that you have benefited, you have enjoyed the engagement. They have been of a benefit to you. And I believe your questions have been responded to. I want to believe that you walk into tomorrow better than you came today. Tomorrow shouldn't be a happy Friday for you. So special thanks to our speaker today, Ms. Christine Kaloki, and our panelists, Mr. Moses Juguna and Erica Yugi. Big up to you guys. You've done a marvelous job in responding to the various questions, breaking the topic NSSF changes of February 2026 for our listeners, helping them have clarity on what these deductions mean to them, how they impact their payslip, and how they impact their retirement, their future, which we are calling the retirement. I want to believe those who are employers today, you have some clarity in terms of what actions you can take back home, and probably you would want to implement for your organization for the good of your employees, because I think those are your main key resources that you want to ensure that every coin that you are paying for them or you are deducting for them have the maximum possible impact in their lives. And Odmicho is here to work with you through that journey, either as an employer or the employees. If you need further consultation, Odmicho has unlimited number of resources, financial consultants who can help you. Reach to us through the socials, reach to us through the 2208 short code. Reach to us through pensionservices@oldmutual.co.ke, and we'll avail resource to you to support you, to work with you through the journey. Even the questions that probably you are not being able to ask, we'll have someone come visit your company and you can have them answer all the questions. Thank you once again very much. We can assure you that we'll send the presentation to you, the recording as well, for those who want to listen probably as you drive your 2-hour traffic tomorrow. As a resident of Nairobi, I don't know the rest of the country, what's your experience, but I'm sure this our webinar you can listen through traffic. So once again, thank you so much. We look forward to hosting you for the future sessions, and we can assure you that we have great topics lined up from Old Mutual in different fronts, not just retirements. So walk to our socials, the X platform, the IG, the Facebook, and you'll be able to see our updates in terms of upcoming engagements. Have a good evening. Thank you so much. Once again, thank you.